U.S. casinos experienced a wave of wagers in 2023. Commercial gaming revenue for the year reached a record $66.5 billion, surpassing the prior record set in 2022 by 10%. So, how can casinos translate what was a record year for revenue into shareholder returns? For more on this, we turn to John Decree, who is the CBRE Capital Advisors Head of Research and Director of Global Gaming. Great to have you here with us on this topic. Let's start right there. After a year that we did see with the amount of wagers that were handled for casinos, how can they make sure that investors reap the benefits as well?
Yeah, I think that's the million-dollar question in the boardroom with the results that we've seen this past year and the trajectory of wagers and earnings of all these casino companies. We're generally surprised at how the stocks have performed. I think people have been anticipating a recession for the past 18 months, and it hasn't really come yet. So, we've seen companies starting to buy back stock in droves. MGM and Boyd Gaming are two that have been buying back a lot of stock and have seen strong share price performance on a relative basis. But the year ahead, I think companies just need to execute. The demand is there. They're managing some wage inflation, cost inflation. But these are free cash flow stories. They're value equities largely across the board in a market that's looking for growth. So I think casino companies will have to look for growth on top of what's been a record year, and in the interim, maintain discipline and use that free cash flow, and buying back stock seems to be one of the preferred methods for companies to create some value right now.
John, you mentioned one of the headwinds facing the industry is wage inflation, cost inflation right now. In terms of what that means or how you see that impacting, we know how it has impacted the bottom line over the last couple of quarters, but what that means here looking out for the rest of 2024, how big of a challenge is that for the industry at large?
Yeah, it feels like probably the largest annual increase in operating expenses for casino companies that we've seen in a long time. Wages is certainly a big piece of that. And after a couple record years of profits, things are catching up, like employee wages. There's pretty significant renegotiated union contracts that came this year, particularly in Las Vegas. And so it is a headwind. I think we're looking at mid-single digit OpEx growth for casino companies broadly this year, and maintaining mid-single digit revenue growth off the high base that you've mentioned, Brad, is going to be pretty challenging. So, I think they'll continue to find ways to mitigate costs in other places, and keep driving revenue. So they'll have to find new ways. They do have digital forms of gaming now. Sports betting has been a big boon for the industry, iGaming as well, and that's a key area of growth that a lot of casino companies are participating in, like Caesars and MGM, and that's a growth source that'll help offset some of the stagnation they might have in core earnings from all of that operating expense growth.
We're going to come back to that digital gaming side in a second here, but just staying on the physical properties that they operate as well. Are casino resorts recession-proof as the leisure makeup that we've seen in the experience economy decelerates from some of the revenge travel rebound that we had been tracking?
It's a great question. It gets tested and debated quite a bit. I think the term I like to use is recession resilient. And we kind of break it into two groups: your regional casinos, which are frequently visited by customers a couple times a week or a couple times a month, and they tend to be quite recession resilient. Las Vegas obviously had a challenge during the great financial crisis. That was a mix of very low demand and significant supply growth, but we've seen Las Vegas evolve substantially since then. We've got professional sports teams and huge entertainment drivers, as well as group and corporate drivers to Las Vegas. So we're confident that the diversity of the Las Vegas Strip business is going to help them continue to be resilient. Supply growth is very moderate. So, we think these businesses hold up very well in a recession. Obviously, every recession is quite a bit different, but so far, demand has been good across the board. It's been outstanding in Las Vegas. It's been stable in the regional markets, and absent the operating expense inflation that we've talked about, these companies continue to perform very well.
And Jan, just lastly, while we have you here, top pick on the property management side there that you got for some of the casino operators, and top pick as well on the digital. I said we'd come back to that.
Sure. Yeah, I think Caesars is our top pick, and they give you a little bit of everything. They've got a budding sports betting and iGaming business to go with their casino portfolio, land-based portfolio that's undervalued right now. They're doing very well, and we see the most upside in that stock. And then on the digital side, we like Flutter. They just listed in the U.S. They share a listing in London. They operate the FanDuel brand, which is the leader in OSB and iGaming right now. And on a relative basis, given their size and scale, I think they're relatively cheap compared to some of the other competitors in the space. So we like Flutter on the digital side.
All right, John DeCree, great to have you here. Thanks so much for breaking that down, some of the plays that you still see as an opportunity despite the slowing economic growth that we are experiencing. All right, John, thanks so much for that.